Hello, everybody. So my Patreon members have told me they want to see some new stocks. So here we go. I have 7 stocks, some of which I've already talked about, like I have Hims and LifeMD in there. I've talked about those, but others I haven't talked about in as long of a time. So let's go ahead and begin with On running shoes. So the last time I talked about On running shoes was early 2024. So it's been a long while that I haven't discussed On running shoes. Going through my spreadsheet, I was surprised to see that it's trading under 0.2. This used to be the very hip brand. They had a lot of buzz around the Olympics. This stock had gotten expensive, and now it looks like it has gotten cheap again. So On running shoes, they make these expensive running shoes that a lot of people seem to love, and it's now cheaper on EV over GP over RG than the last time I covered it. So last time I covered it, I may have told you, founder-led company, very interesting ownership structure where the founders really can't be stripped of their ownership rights. So very interesting stuff. Mission-driven company based in Switzerland, founder-led, like I said, very high-performance shoes. They pride themselves on performance. Anyways, I don't know any sports brand who doesn't pride themselves on that, but perhaps they have something to say about these shoes. They have a dedicated following. People tend to love these shoes. They just won't stop talking about the shoes. So dedicated following, definitely. And it's trendy, right? So you see this in fancy neighborhood. People wear those, etc. It's an expensive product, like I said. Probably explains some of Nike's trouble. Because these stores, when they go into a town, these stores tend to be pretty popular. Lots of people going in, lots of people checking out. And like a lot of companies in that industry, they try to get into apparel. And of course, that's logical. You have a brand of shoes, you're trying to, double down on that brand and on your branding expenses. I don't really know if that's going to work. But anyways, the point is, beyond even needing a bigger analysis, looking at the numbers, this stock looks good. It's 36% forward revenue growth predicted, so it's going to grow more than 30%, which is my minimum. Gross margin is 61%, which for manufacturing is excellent. EBITDA margin is 12%, which is good enough. I mean, they're squarely making money. So you're looking at a company, like I said, that breaks the rule of 40 at a 48 versus 48, so it's very high. And EV over GP over RG is 0.18. So cheap. I find it too cheap. I find it interesting. Now it's a matter of, do you want to be invested in one of the Nike's challengers, right? That's one of the big questions out there. So anyways, let's move on to a stock that I own, that I still like very much. This is also a long-time favorite on the channel, perhaps one of the earliest stocks I covered on this channel. It's Oddity, Odd stock. So I seem to be alone on this one. But I like it for multiple reasons. I like it because in their products, they incorporate AI. And I like it because they're only direct to consumer. They don't go through a store. And I like it because the valuation is cheaper than the other big play in that sector, which is ELF. And I also like it because cosmetics, just like Hims, for example, cosmetics have a recurring revenue component. People come back and buy cosmetics because they use them. So there is a recurring revenue component to Oddity, to this company. So I like this brand quite a bit. This company as a platform, which they call Oddity Labs, and in Oddity Labs, they try to build brands. And their goal over time is to have $4 billion plus brand, 4 brands that generate more than $1 billion in sales. Now, right now, they have 2 brands, and they think that over time, Makiage first, but SpoiledChild second, they think that over time, each of these brands will do more than $1 billion in sales. And these brands have been growing very fast. The market is excited about Brand Free. Brand Free will be announced in the end of the year, towards the end of the year. Brand Free is going to be a medical-grade skincare business. So probably some sort of a prescription going on with Brand Free. That's going to be Brand Free. But so on this stock, I've talked a lot about on this channel, I've talked a lot about Makiage. So Makiage is their AI-driven foundation business where they analyze the skin and they create a custom color for you. And then women have no choice but to go back to that custom color because, it's created with AI, etc. Today, I want to talk a little bit about SpoiledChild, which is a very other brand. I haven't talked too much about that other brand, but it's a peptide brand. Well, they do some peptides. It's anti-aging / skincare, peptide hair hair brand type of brand. So you can look at the product. You can see the traditional way to sell, for them to sell is they go by social media. So all of the products are highly social media friendly, and you can see these are anti-aging, collagen, right? A collagen peptide, or other sort of serums, etc. Expensive products, very high margins, and you can see these products are sold. This product gets sold. Like look at that random one I took, Biotin Boost Support, so for hair care, right? This one is what? 45,000 reviews. So this product get a lot of sales, and the way they sell these products is obviously through social media. And I've clicked on a few of these social medias. Like some of them have more than 100,000 followers. Some of them. So this is how they sell, through social media. So, and of course, if you want to sell through social media, you have to be social media friendly, which is you do a shiny bottle and it has to look good. Kind of like Celsius does it too, right? Celsius sells through social media like that a lot. So I find this very interesting. I think this company is connected with the times. I think they understand how to sell to the younger generations. Not something you can necessarily say from a brand like L'Oreal or Estee Lauder. And I like it especially because it is cheap. It is very cheap. EV over GP over RG is a 0.23, rule of 40 is a 55. Company is predicted to grow next 12 months at 26%. Gross margin is 72%, very high for a physical product. EBITDA margin is 29%, even higher for a physical product. So this stock, in my view, is doing quite well, and I like it. Moving on to Hims and LifeMD. So Hims and LifeMD, they need no introduction on this channel, especially Hims. Hims needs no introduction on this channel. Hims has become a trader's favorite. I'm a long-term investor in Hims, but some people love to trade Hims. It's become a trader's favorite, perhaps even more fun to trade than Bitcoin, because yesterday we had what I would call a nothing burger news, which is the CEO moving to an advisory role. Okay, Hims is probably a very tough company to work at, so sure. It's okay. They'll find another COO. That's to me, that's no issue. I think the market, I don't even know if it's the market who sold off of that. It's ridiculous. Minus 9% for that. I mean, the stock did not really pop when the CEO was added. So when the COO was added. So anyways, up, down, the stock is all over the place. But over the long run, make no mistake, the direction is up. The revenue is not all over the place. The revenue is going up on this stock. What is Hims? I've said it before multiple times on this channel. Hims is not just a GLP-1 company, like analysts would have you believe. Hims is only GLP-1. No, Hims equal an e-doctor. It's a network of doctors, more than 1,000 of them on their platform that are registered on the platform. It's a platform of doctors. It's an e-doctor, mostly nurse practitioners, but some doctors. And in addition to an e-pharmacy, a digital pharmacy, a compounding pharmacy, right, a highly automated warehouse that manufacture drugs, well, take components and put them into pills is what I should say. They manufacture some of it, but very, very little. Some of their peptides they do, but otherwise it's just you take the compound, you put it into pills, you put it into the excipient, as we call it, like the rice powder or whatever. But they customize that. So it's a customized e-pharmacy. So it's a customized / compounded e-pharmacy. It's an e-doctor. And it's all of those together minus insurance. They don't take insurance. And so digital, automation and digital, no insurance, i.e. no complexity. That means you can charge less than copays. That's the whole point of Hims. CEO has been caught saying multiple times, average American spends $2,400 a year on copays. We think we can solve average issues for less than $200 a month. That's what they've said a few times. And I think this is true. And it's faster than Trad Health. And you could argue it's faster than Trad Health, of course, because you can see a doctor in 24 hours. And you don't have the issue of ping pong. The doctor doesn't want to treat you and the doctor sends you to the specialist. That's the ping pong issue. You don't have that issue with Hims. And arguably, it's better. I would argue Hims is better arguably because it's all customized. You have all of your data in the app. There's many reasons why I would argue it's better. So to me, a company like Hims has all of the components of a 0 to 1 company. In addition to that, they move very fast. They just launched testosterone. Testosterone is going to be the next big thing for Hims. And they're going to launch menopause pretty soon. So that's also going to be good for them. So they're moving beyond GLP-1s. The market still dismisses them as a GLP-1 only company. Valuation on Hims, 0.16, still very cheap. Rule of 40 is a 55. Company predicted to grow 47% next 12 months. Gross margin 76%, EBITDA margin 8%. I like Hims valuation, although I liked it way better in the 40s. But I still like it at these levels. And let's talk about LifeMD. So LifeMD is another company that I've covered a few times on this channel. I typically cover it more when Hims is expensive. So if Hims gets back above the 60s or the 70s, expect me to cover more LifeMD. I consider LifeMD to be a mini Hims. It's a small Hims. Just like Hims, recently LifeMD launched their remote pharmacy, so they are going to fulfill their own drugs, so they are becoming more of a network of doctors plus the digital pharmacies. But initially, LifeMD was the network of doctors, and really it's not a network. Really it's an office in New York City with a bunch of doctors that are certified in all 50 states. That's really how they do it. But anyways, they offer monthly doctor subscriptions, and so one of their popular subscriptions is LifeMD Plus, $19 a month. You can see a doctor, unlimited virtual care for $19 a month. That's extremely compelling. To me, I don't see how this doesn't catch on more. I mean, it is catching on slightly. Company is growing fast, but I don't see how it's not growing faster than that. And the main difference between Hims and LifeMD is that LifeMD tries to use your insurance for medication. And so because they never compounded the GLP-1s, they still offer GLP-1s partnership with Lilly and Novo. They still offer the GLP-1s, so starts at $4.99, and they try to get your insurance to cover it. Now, on the last call, as we saw, they didn't have much success of insurance covering it, so they end up sending the medication. But then the insurance doesn't cover it, so they have to refund. So insurance coverage, that was their bet. We'll see how that goes. But it seems like a lot of insurance companies don't want to pay for weight loss, and they don't want to cover weight loss as a treatment. So anyways, we'll see which strategy will have been the best. And of course, Hims' strategy, as you know, is compounded GLP-1. Their strategy is to compound them. And, compound them for medical reasons, of course. But that's the strategy of Hims. And that's why they lost the Novo partnership, because they kept compounding and Novo doesn't want them to compound. LifeMD also interesting in the sense that it runs one of the many Hims copycats. Their copycat of Hims is called REAX. There's multiple Hims copycats. LifeMD runs one of them, right? Another one is a private company called Ro, as you may know. Ro is also a copycat, but they run that, and they own Work Simply. And it's important to note that they own Work Simply. I've covered this company before. If you were to remove Work Simply, which grows flat, and Work Simply is about 30% of LifeMD. If you were to remove Work Simply, the growth rate of LifeMD would be much more in line with Hims. But because of Work Simply, the growth rate that they show is not as high, because Work Simply is just a business that they have up for sale, but they're waiting for the right buyer. And so who knows if they will ever sell it or not. But it's a slightly meaningful business. And so that kind of complexifies the story of LifeMD. Last thing going for LifeMD, they bought an osteoporosis treatment network or platform a few months back, and they're about to launch their own women's health section. So again, if they launch menopause, right, they're going to launch menopause. Hims is going to launch menopause. You see kind of a parallel. Yeah, LifeMD remains, in my view, the mini Hims. They're competing on weight loss. They're competing on menopause. They're competing on fulfilling pharmacy subscriptions. The one thing that I guess LifeMD doesn't compete with Hims on is that subscription, that doctor access subscription. I think that's a very powerful offer. So we'll see how that goes. Of course, LifeMD, a company nearly 10 times smaller than Hims. So not a direct comparison, and still under the radar largely. So anyways, moving on to Kaspi. So Kaspi, I covered on Patreon Kaspi a few months back. I still need to take a day off. When I take a day off, I will make the video. I did a 30-minute analysis on Kaspi available. I will make it available to the main channel the day I want to take a day off. I don't know when that is. Anyways, let's go about Kaspi. So Kaspi, of course, I was attracted to Kaspi because it's cheap, 0.15, and rule of 40 is at 89. No, I don't. I don't necessarily look to invest in Kazakhstan. I don't necessarily. I don't wake up one morning and tell myself I want to invest in Kazakhstan, even though it's very nice. No, no. I got attracted to this stock because it's cheap. This stock is cheap. They are the super app of Kazakhstan. So, what do we mean by the super app of Kazakhstan? Well, stuff, right? E-commerce. So get your stuff. Get stuff, and they do groceries and they do all sort of stuff, kind of a mini Amazon, etc. They do saving, they do credit, they do money, okay, and then so fintech payments, right? And then they also do something very unique in Kazakhstan, which is they do a lot of the things that you need to do with the public sector, like I don't know, like a marriage license, ID, passport, all that sort of stuff. They cater to that in Kazakhstan. So they help you register your car and all sorts of that. So it's really the super app of Kazakhstan. And they used to be a bank. And they're a bank who was able to do a 180 and become a super app. And it's great. And they have a near monopoly in Kazakhstan. And they make a bunch of cash in Kazakhstan, lots of money. The Kazakhstani currency, which I think was the tenge. I think it's the tenge. Anyways, their currency, when I did my full analysis, is a pretty stable currency. Very oil based, so pretty very commodity based, so pretty stable currency. So we don't have the same type of currency risk that we're gonna have, for example, when we're moving to Turkey. But that's not necessarily always a bad thing, because you just end up having higher growth rates when you have currency risks. So like Mercado Libre in Argentina, that was an example of that. But anyways, this company has decided to make a move and to expand in Turkey. And so in Turkey, they bought, one of the top 5 e-commerce sites, Hepsi Burada. They bought that site, and then they also bought a bank. And they're trying to recreate a super app in Turkey. Why is that important? Because Turkey is a 4 times bigger market than Kazakhstan. So we're hoping to move there. They're hoping to expand over there. The stock hasn't done much, down 24% in 1 year. And a lot of that stock decline has to do with the fact that the Mr. Market dislike acquisitions. Acquisitions are bad. So imagine that they did 2 acquisitions, a bank and an e-commerce site. So that's why we don't like it. I personally prefer to see them invest in growth, because I'm not interested in dividend, right? So I prefer to see them invest in growth, and maybe they can move in other countries in the region over there, like I don't know, like Mongolia or Georgia or you name it. But maybe they can move into other countries over there. But anyways, I prefer to see them invest the capital back into expansion into the business. And so that's what they're doing now. So they used to have a dividend. They used to have an 8% dividend. They don't anymore. I don't think they will anymore, because they're investing in these units. Anyways, company growing 22%, but gross margin is 79%. And this is true. EBITDA margin is 67%. This is not a typo. This is a business that makes a lot of money on these transactions. And when you end up having that, what do you find? Well, you find a rule of 40 of 89 and an EV over GP over RG over 0.15. This stock is quite cheap. I like it a lot. Moving on to REAX, the Real Brokerage. So REAX stock. So it's all this is all a bet on interest rates coming down and real estate recovering. You may remember my video last week. I also covered it, so I'm going to go quick. But essentially, REAX is a digital app-based broker that tries to go after the top brokers that are working at your local mom-and-pop Keller Williams or Century 21. So they got the app, and they tried to get the top real estate agents to go it alone, quote unquote, go it alone, but actually on the back end use REAX, and REAX allows them to create an app, allows them to create a website, and they're really focusing on attracting the top agents and getting them to move to their platforms, as opposed to, say, a traditional mom-and-pop broker, which will put a lot of value on mentorship and getting new agents, etc., etc., etc. So this is an asset-light capital model. This is why I like it more than Open Door, because Open Door had to put a lot of capital to buy these houses and refurbish them and resell them. And what I like about REAX, and I think REAX is relatively undiscovered. Very few people talk about it, even though it has grown like mad during the enormous downturn of 2022 until today. A downturn not necessarily in price, but a downturn in transaction. We've had a lot of we've had very low transactions, and despite that fact, they've been able to grow. So what that means is that growth has to do with the top agents moving to REAX and taking their transactions on the REAX platform, because REAX has a very interesting fee structure for these agents. So, if we look, REAX for Real Brokerage, enterprise value over gross profit over revenue growth is 0.11, Rule of 40 is a 53, and we have a company that has a history of growth, predicted to grow next 12 months, predicted to grow revenue at 50%. Of course, when you're in real estate, the downside is obviously the margins, only 3% EBITDA margin, but that is to be expected, and that is, of course, compensated by the fact that price to sales essentially is so cheap. Right? Price to sales is only a shadow of a sales number, because sales number is 1.6 billion, 810 million is the enterprise value. So anyways, that's how it's compensated. If you want high margins, don't do real estate. That's the moral of the story. And the last stock that I haven't talked about in a while, but that still keeps coming up in my spreadsheet as being so cheap, is Delcath. And you see in the spreadsheet I have dozens of innovative companies in the health sector, in the pharma sector, right? I have dozens of them, but of course I only pay attention to the very cheap ones. This one is a very cheap one. I don't really know if that's warranted or not, that it's a cheap one. Enterprise value over gross profit over revenue growth is 0.04. Rule of 40 is a 160. Predicted to grow revenue at 120%. EBITDA margin is 40%. So what does this company do? They deal with uveal melanoma. Anyways, it's a cancer that starts in the eye and ends up in the liver. Don't ask, but it's a rare disease. It's a rare cancer, and unfortunately, it's a cancer for which there is not a lot of treatment for 55% of the people. So there is one treatment called Kimmtrak, but there is a restriction due to HLA. So it's a HLA restriction, so that has to do, of course, with your tests. So there is a restriction where you can't take it. So there's 55% of the people who can't be addressed with the main treatment, and so they are the only one for that 55% who can't be addressed with that main treatment. This company is interesting because it's a sort of a injection, or like a catheter company. So they sort of isolate. It's a perfusion, but they isolate the liver and they do targeted treatment, a very, very, very targeted treatment on the liver and the liver alone. And so they hope to expand to many more diseases that need to isolate organs and just saturate organs with a chemotherapy drug. But that treatment is very expensive. Why is it so expensive? Because there's only between 800 and 1,000 patients possibly eligible, because uveal melanoma is already a very rare disease. And then you gotta go through all of the steps to qualify for the treatment. So approximately 800 patients are potentially eligible for the treatment. And as a result of that, the treatment costs $768,000, which for those people who are eligible is actually cheaper. They tried to price it cheaper than Kimmtrak, which is the competition for this rare disease. And Kimmtrak is $839,000. And like I said, 55% of the patients can't use Kimmtrak because of that restriction, and so they would be moving to Espado, provided that reimbursement can be figured out. There's two issues to adoption. One of them is the oncologist. Oftentimes, oncologists, and this is the same issue as with GenMab. I've talked about that issue before on the channel. If you follow the channel a long time, oftentimes they don't want to use the more advanced treatments as the first line of defense. They want to use, oftentimes, arguably less efficacious, but also very much less costly treatments as the first line of defense. Oftentimes, and it's, again, this is not my field, but But here we have Delcath, who says, well, wait a minute, we can also be used as a first line of defense. But indications, the FDA kind of controls that and makes sure that the more expensive treatments are not used as a first line of defense. I personally believe when we reach our 60s, we should all have a health savings account with $1 million. So we can just use the $1 million in the savings account just in case we get a super rare disease, and that's kind of what I believe. But unfortunately, that's not how the system works. And sometimes doctors want to use the less expensive or like the more established form of treatment first before moving to the more advanced, but orders of magnitude more expensive form of treatment. And Delcath spends a lot of time talking about reimbursement and reimbursement procedures and how hospitals get paid and also like getting into the rebate program of CMS. I'm not interested in the reimbursement system. It's I find this extremely boring. So like it's important. But I don't pretend to be an expert, and even then, I see analysts being confused with all of this reimbursement and the way it works. I just know this is always why these businesses trade at a discount, is because you can have a change in CMS, a change in Medicare, and then they could decide to change a code or something, and then you lose your reimbursement for the business, and then if you lose the reimbursement, you may lose the entire business, right? So it's what happened to Semler Scientific, right? Semler Scientific, I've covered a few times on the channel. They pivoted to Bitcoin. Why? Because all of a sudden they had a product, and all of a sudden CMS stopped paying for that product. So that's part of the risk, but that's also part of of the reason as to why they are so cheap. Now, I want to say for the Hespado and Delcath, for the business here, they have potential to develop other forms of treatment with their HGS delivery system, other forms of treatment for more widespread issues and widespread cancer. So that's part of the hope. I like this company. I own this company. I'm willing to take the risk. Why am I willing to take the risk? Because it is so cheap at a 0.04. It's cheaper than Oscar, cheaper than LifeMD. Perhaps top 5 cheapest in the spreadsheet, perhaps, right? So anyways, this was not investment advice. This is not financial advice. This is only entertainment. This is not medical advice either. No beauty advice. Just entertainment. I only entertain. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.